In this week's market update, echoes of 2008 as the Fed promises unlimited asset purchases, the UK locks down, and investors brace themselves for dreadful economic headlines. It felt like 2008 all over again on Monday after the Federal Reserve said it would make unlimited purchases of US Treasury bonds and mortgage-backed securities in a bid to get ahead of the spiralling coronavirus outbreak in America. In other ways, however, the current situation could not be more different from the financial crisis, not least here in the UK, where the country entered a draconian lockdown on Monday night. The unprecedented step was made in a bid to slow the spread of COVID-19 and protect the ability of the NHS to handle an anticipated sharp rise in cases in the next few weeks. The dramatic intervention by the US central bank followed the failure over the weekend and into this week of politicians in Washington to agree a package of fiscal support measures. This was another reminder of the financial crisis when Congress initially voted down a bailout package known as TARP, or the Troubled Asset Relief Program. This year, as then, political paralysis caused turmoil in the markets, forcing the Fed to step in with its own monetary bazooka to calm sentiment, temporarily at least. Stock markets regained their poise on Monday after the Fed's move, reversing earlier losses which had focused on fast deteriorating news on both the spread of the disease and the likely economic impact, and the absence of a coherent fiscal response in the US. On Tuesday morning in Asia, stocks continued to rally as investors decided this was the Fed's whatever it takes moment, a reference to Mario Draghi's intervention in the Eurozone sovereign debt crisis 8 years ago. In Japan, Topix was 3.2% higher and the Nikkei even stronger. Australia rebounded by 4.2%. South Korea was up more than 8%, while China's CSI 300 index added 2.2% and Hong Kong rose 4.3%. This week's recovery followed a weekend in which evidence mounted that the economic hit from coronavirus will be savage. Goldman Sachs warned that coronavirus threatened to push the world into a deep recession. Germany's economy is now expected to contract by 5% in 2020. The US might see a fall of 14% in second quarter GDP before a second half recovery that could, at best, take the economy to zero growth for the year. In Israel, unemployment has quadrupled to 18%. The grim economic news followed another escalation of the number of cases and deaths caused by the virus. The global tally of cases has hit more than 370,000, with more than 16,000 deaths. More than a quarter of tests in New York City are coming back positive, suggesting the virus has been circulating there for weeks. There have, however, been the first faint glimmers of hope that life will, in due course, return to normal. Shanghai downgraded its emergency alert level from 1 to 2 after reporting lower numbers of new cases. Across China, 39 new cases were all said to have involved travellers entering the country from abroad. This offers some hope that the disease can be contained in time, even if the different approaches to containment and suppression around the world suggest that the trajectories of cases and deaths will also be quite variable. All eyes are on how the outbreak develops in the US, where a privatized healthcare system and a general absence of support mechanisms, such as sick pay, threaten a very different outcome than in countries with either stronger state control to enforce suppression measures or better funded and more centrally controlled health services. Analysts believe that the US holds the key to whether markets, already around a third lower than their recent peaks, will suffer another major leg down to mirror the 50% or more declines experienced in the bear markets that followed both the bursting of the dot-com bubble and the financial crisis. An analysis of bear markets over the past 200 years by Peter Oppenheimer at Goldman Sachs concluded that different flavors of bear market result in different degrees of price fall and different recovery times. He said that the average decline for share prices was 38%, with a 60-month average recovery time, but a wide dispersion of outcomes around these averages. So-called structural bear markets, triggered by economic imbalances and bubbles, tend on average to lead to much bigger falls of 57% on average and a 111-month recovery time. More common cyclical bear markets caused by rising interest rates bearing down on economic activity and profits have generally led to a 31% peak to trough fall and a 50-month recovery to the previous peak. The most benign bear markets of all tend to be event-driven slumps like 1987's Black Monday or arguably the current Black Swan coronavirus event, which typically result in a 29% decline and last just 15 months. On the face of it, this argues for a V-shaped short and sharp bear market in 2020, but Oppenheimer warns that with interest rates on the floor and consequently little firepower for central banks to offset the damage of the global economic shutdown, the current bear market could change shape into something nastier and longer lasting. That said, timing bear markets is notoriously difficult, and investors are rightly wary of being caught out of the market when it does rally. History shows that rebounds, such as in 2003 and 2009, can be rapid, leaving investors who sold out of the market compounding their initial mistake with a second one. Analysts are struggling to put numbers on the depth and duration of the now inevitable downturn. Bank of America predicts a drop in global growth to 0 this year, with China growing at just 1.6% and recessions in both the US and Europe. Another estimate sees 1 million jobs being lost in the US alone. The scale of the potential damage to the global economy has put governments and central banks around the world onto a war footing, with most agreeing that there is no price that's too high to prevent a worldwide collapse. Measures include cheap loans to businesses and extensive support to companies that keep workers on the books throughout what is hoped to be a temporary hiatus in trade as countries move into lockdown. In the UK, for example, the government has promised to pay 80% of wages up to £2,500 a month in a move that's hoped to persuade bosses to hold on to workers rather than lay them off. The need for such dramatic measures was underlined even before Prime Minister Boris Johnson addressed the nation to announce an effective 3-week lockdown of the whole country. There had been a steady stream of announcements that only a few weeks ago would have seemed implausible. McDonald's closing all its UK restaurants, Ford halting most production around the world, and a string of companies saying that they can no longer give any guidance about future profits. In response to this, the UK regulator, the FCA, told companies not to announce what are increasingly meaningless results for at least the next 2 weeks. In these circumstances, it's easy for pieces of news that would in normal times be world-shattering to fall off the radar as soon as they've been announced. The Bank of England's cut in interest rates to an unprecedented 0.1% last Thursday is a case in point. No sooner announced than forgotten about as the relentless news agenda rolls on. The Bank of England will be in the spotlight again this week as Thursday sees the conclusion of its scheduled rate-setting meeting, already preempted by the budget day cuts in rates from 0.75 to 0.25 and the cut to 0.1% just over a week later. Well, it's been a baptism of fire for new Bank of England Governor Andrew Bailey, who took over from Mark Carney at the beginning of last week. On the corporate front, in the absence of results announcements, attention will focus on the fast deteriorating news on dividends. Yields currently stand at implausibly high levels for most of the blue chip companies in the FTSE 100. Until it's clear how many companies are going to cut their payouts and by how much, these numbers should be treated with extreme caution. Many dividends, it now seems certain, will not be delivered. In other markets, oil is gyrating on mixed messages for the energy markets. The price tumbled again on Monday by more than 5% to around $25 a barrel for the Brent contract, as demand destruction, notably by the airlines, runs ahead of the ability of the oil industry to cut production. Then it reversed direction, heading above $30 a barrel again on reports that President Trump may intervene in the Saudi-Russian oil price war.